As I joined the bank, we became responsible for overseeing the insurance industry as the supervisor, and that of course includes Lloyd's of London, so it's one of the largest reinsurance markets in the world. And if you oversee the insurance industry, and particularly Lloyd's, you realize that catastrophic risk, the mounting physical risk from climate change, are a fundamental element of effective insurance risk management. And even back then, so 2014, it was a requirement of Lloyd's members to manage climate-related risks. I mean, it was that fundamental. That sounds every day now for a financial institution. At that point, it was cutting edge. And the second element of that was to understand that the history had been that the frequency of extreme weather events had more than tripled over the course of a 25-year period. The insured and inflation-adjusted, I should do that as a central banker, inflation-adjusted losses had gone up 8 times. And that, past, the tail risks of the past were becoming into the central scenario of the day, and you could project that forward on reasonable climate outcomes. So just the physical risk element was required. And then the second thing was that as we rolled into 2015, as the world moved towards what became the Paris Accord, there was a growing realization, I think we felt at the bank, that there was another risk, which so-called transition risk, that related to, well, what if the world actually gets serious about addressing this issue? We bring into the regulatory framework carbon pricing. We bring in certain restrictions and/or subsidies, and that business activities and financing activities associated with them that were profitable become less profitable, actually have risks, and of course that crystallizes in stranded assets and risks around it. In effect, what we're trying to do, and really this began with COP26 in Glasgow and has extended on over the course of the last few years, is put in place the information, the tools, and the markets so that financial institutions can not just manage climate-related financial risks, but seize the opportunities. And if anything, over the course of the last few years, the focus has increasingly been around that information set, those markets, so that capital can get behind climate solutions. And there's a very broad range of climate solutions. And with respect to our focus, it is very much in the E, and it's very much in the easy bit of the E, if you will, which is the transition towards net zero. So we're operating in the space, if you will, of ESG, where there are hard numbers. What are your emissions today? Where do you think they're going tomorrow? What capital can you put in line in order to move those forward? And how does that look relative to where Australia, where the world needs to go to get on that pathway to 1.5 degrees? The easiest ways, or one of the necessary conditions, maybe a better way to put it, for a just transition is to start early, is to be clear about your destination. It allows workers and communities to prepare. It allows governments to participate alongside. The last thing I'll say in terms of just high-level guidance, one of the things we've done at GFANZ, in part in response to, I think, an overly, if I may, a simplification of the energy transition, which developed in the last few years, which in effect said no new oil and gas, none whatsoever, and it became that any financing related to traditional energy, conventional energy, oil and gas was a bad thing. That's not right. That's not what the energy transition requires. I think you see it very much in Australia with the role of gas, and I know Frank Calabria was speaking earlier. I'm sure he probably emphasized the role of gas in transition. But by the same token, it's not a carte blanche for investment in oil and gas. There has to be guardrails. So one of the things we've done is working with the IEA, working with others, is to provide some dimensions around where clean energy investment needs to go versus conventional energy. In effect, sorry, and I'll finish on this because I know we're short on time, but in effect, a few years ago globally, that ratio, clean to conventional, was about 0.5. Today, fast forward with the big boom in clean energy investment, it's about 1.1. It needs to go to about 4-to-1 by the end of this decade. We're spending a lot of time now on what is becoming the biggest challenge in the global transition, which is the transition in the emerging and developing world. And I'm going to grossly simplify, but I think Australia is an example of this, where we see increasingly in the developed countries, the advanced economies, clearer climate objectives, climate policy moving towards those objectives, financial institutions getting oriented to getting capital behind solutions, industry moving. Yes, there are issues. You know, we need to build 10,000 kilometers of transmission lines, for example, and I'm sure Frank talked about that in Australia by 2030. There's lots of issues, but the system is surfacing those issues. The capital's there. We can get there if we remain focused. A different challenge in non-China emerging markets, if I can put it that way. They need about $1 trillion of capital per year extra between now and the end of the decade. And where's that going to come from? And what's the role of institutions like the World Bank? How do they catalyze private capital in big multiples for that? So we, GFANZ, are spending a lot of time on that hard problem, because we know that we can do everything right, or largely right, in our economies, but we collectively won't get to net zero and address climate change unless we do everywhere. So those are a few things that can be done. The first is all of this work that's been going on over the course of the last decade around climate-related financial disclosures. So I mentioned the TCFD. Your audience, I'm sure, is well familiar with it. It began as a concept only a decade ago. It's been taken up by many of the world's largest companies, including the largest Australian companies, largest financial institutions, and got to a point where it really needed to be formalized and made mandatory. Literally in the course of the next 2 weeks, the International Sustainability Standard Board of the IFRS will come out with their final disclosure recommendations. So one of the things we can do, whether we're in Canada, the UK, Australia, is to adopt those recommendations, certainly for larger public companies, and then gradually tier those down through in a proportionate way through the economy. So there is a consistent standard, a comprehensive standard, widely applied. And that helps to build trust. That's in the end one of the core roles of authorities, is to provide level playing fields like that. I think the second thing is to ensure that and this is part and parcel of this, is that there is an increasing understanding of the likely forward emission path of companies. Now, there are always execution issues with this, but one of the factors and one of the things that's coming into markets, I'll try and bring my answer to a close so we can move on, but one of the things that's happening in markets, particularly where there has been comprehensive disclosure, and you see this in Europe, you see this in the UK, is that within a sector, lower emission companies trade at a valuation premium. I mean, that is a consistent result. It's a big challenge globally. Central banks are starting to get on top of it. The challenge is to stick with. The challenge is we need restrictive monetary policy, and I'm in the UK right now. We certainly need it here. It's needed in Australia, elsewhere, and we'll need it for a period of time. And the judgment of the central banks will have to be to what extent is duration their friend, as opposed to amplitude of the restrictions. In other words, one's policy is adequately restrictive, stretching that well into next year is likely the strategy to bring down the final elements of inflation towards these inflation targets. To summarize, the good news is that central banks are getting on top of this. The less good news, or the reality, I think is maybe a better way to put it, is that we will need restrictive policy for a period of time. And that's not something that our economies have faced for some time. It helps last point, it helps to have a very robust banking system as you do in Australia. I would be more concerned about some other jurisdictions in managing this transition.